Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, and once again, three of the very best in the business to talk about trends in the ETF space. First, Tom Lydon from ETF Trends. We have Andrew McCorman from Wallach Beth and Paul Delaquila from Defiance. Tom, I want to start with you. The NYSE reporting ETF trends for the third quarter, just continuing to move along here. We're approaching $5 trillion now in assets under management. I wonder, Tom, what sticks out to you with ETF trends? How are the flows looking? Of course, this has been a big year for active, non-transparent funds trying to get in on the market. Anything stick out for you in the first 9 or 10 months of the year?
Yeah, Bob, it's been a great year for fixed income. With low rates, lower for longer, you're seeing more investors, more advisors pushing into corporate and high yield bond ETFs. That's been huge, $175 billion there. On the equity side, the message has been traditionally in the last 10 years, it's been the low cost beta strategies, but we've seen a huge shift to not only technology weighted indexes like the QQQs that's brought in like $25 billion. We've seen thematic strategies kind of go through the roof. And then when you mention active non-transparent, a lot of new companies have been around for a while in the mutual fund space are now getting into the ETF business. Companies like T. Rowe Price, American Century, that are putting their stake in the ground in an active way, and that's been great. But there have been some other active strategies like ARK Invest that 2 years ago was $2 billion. Now they're $12 billion. So they're seeing the love as well.
Yeah. And Andrew, besides these active non-transparent ETFs Tom was talking about, the thematic ETF continues to be hot, the thematic ETF space. I want your comment on last week's launch by Invesco of the junior NASDAQ 100. Here's a trend to capitalize on. And those of you who don't know it, of course, the NASDAQ 100, the triple Qs, is one of the most successful ETFs out there. It's the fifth largest one right now. But last week they launched a NASDAQ, essentially 101 to 200, I guess you could call it, Andrew, that seeks to incorporate companies that are using tech in innovative ways, but that are also growing fast. Your reaction to this sort of new spate of efforts to capitalize on the tech craze?
Not surprised to see Invesco. They're one of the biggest issuers, and they've always been very innovative. Like you said, the NASDAQ Triple Q is a beast. But when you really think about that name, and that is the way to represent tech in a large cap universe, it's 40% FANG. So this serves to kind of take some diversity away from those names. They're not even the first person really to come up with it. A month and a half ago, Victory came up with the QQQN, which is the next 50, or they call it, which is Tech Disruptors, Peloton, CrowdStrike. That's up over 12% in a month and a half. But Invesco is going to put that marketing engine behind that. I expect them to get some traction with this ETF. And look, we're in a pandemic-driven or let's say, solutions-driven economy where the companies that are making people's lives easier are the companies that people are investing, the next generation are investing in. And I really think you're going to see some names have success, again, especially with the market cap of the QQQ, which will always get assets. And certainly there's a place for dollars in the FANG, but they're coming under some fire, right? So I think this serves a different investor base and the next leg of growth.
Yeah, and Tom, what's interesting to me is that this NASDAQ Junior 100 ETF, or 101 to 200, I like to call it, has got your typical tech names. It's got Seagate and Zscaler in there, which is an internet security firm, but it's also got non-tech firms in there. I mean, Garmin, Lyft, Zynga, which is a social game developer. I mean, yes, obviously they use tech, but they use tech in innovative ways. I'm not sure they're necessarily technology companies. So there's sort of, even the NASDAQ 100 isn't exclusively tech, obviously, but they're trying to include companies that are using tech in innovative ways, I think.
Yeah, there are a lot of innovative healthcare companies too, but back to Andy's point, the fact that the Qs are stuffed with FANG stocks, and that's done real well for investors over time. However, the key is diversification. And going forward, especially as we're seeing rumblings of antitrust discussions, are we going to be as confident in those FANG stocks going forward? Or here's an opportunity to maybe invest in the future FANG stocks while you can diversify away and maybe catch lightning in a bottle one more time in the form of this next ETF.